The downside to a 3% interest rate, the truth about assumable mortgages that people aren't even talking about, right? So right now, interest rates are in the 8s. They're the highest they've been since 2000. So a lot of people are trying to figure out, how can I get a lower interest rate? There are a lot of options, but a lot of people are discussing assumable mortgages. Now, let's define assumable mortgage. Let's say a person purchased a home back in 2021. And in 2021, they were able to get a interest rate of 3%, right? So now their interest rate is still 3%. But let's say they're in a position where they want to sell their property. If they want to sell their property, the person purchasing their property would most likely have somewhere near 8% interest rate. However, let's say the seller is willing to do an assumable mortgage. Assumable mortgage is where they assume the interest rate and the person buying assumes the time frame that is left on that mortgage. So the only loans that you can assume are, one, you have to be a primary owner, so you have to be a primary residence, and two, it can only be if it's in a government loan, meaning FHA, VA, or USDA. Those are the only 3 loans that are assumable. Conventional financing is not assumable, and you cannot assume a loan as a investor. So that's another thing that we can talk about in a different video. But let's say you have a 3% interest rate. Let's say the person owes $300,000 on their home with a 3% interest rate. The buyer would like to assume their mortgage, and that's great. If they're able to get their mortgage, if they're able to assume that buyer's mortgage, the seller's mortgage, then they have a 3% interest rate on $300,000. Now, these are the sticking points that a lot of people aren't talking about or even considering. If the house is worth $500,000 and the seller only owes $300,000, then there's a $200,000 gap between what the mortgage company is owed and what's owed on the property versus what the seller would like to sell it for. So with that being said, if you are a buyer and you want to assume a mortgage, you have to understand that, yes, if you assume that $300,000 at 3%, you still need the $200,000 to pay the seller to make them whole. There's no financing the $200,000 with the mortgage company because they're more concerned. The assuming of the mortgage goes to you working with the servicer of that loan. You can't bring your own mortgage company and try to assume a mortgage. So the buyer has to utilize the seller's current mortgage company in order to assume their loan. That's why it's called an assumable loan, right? Assumable mortgage. Yes, you get a lower interest rate, but you don't know how long it's going to take. It's probably been 25 years since people have really been doing assumable mortgages. So a lot of these banks don't have processes, and the people that work there have probably never done an assumable mortgage. So when you're going to look into an assumable mortgage, typically in a contract nowadays, standard could, let's say 21 to 45 days, right? I have seen where servicers said it could take up to 180 days to finish the process for assumable mortgage. That's 6 months. Unless the seller has time and the buyer has time, who really wants to wait 6 months to close on the loan unless you have the ability or have the time to do it? That's one thing that they're not talking about. Number two, there's no guarantee that that mortgage company who's servicing that loan is going to approve the buyer for the assumable loan. If they don't qualify for that loan, then you've wasted 6 months. So yes, it is great to say that I'm going to do an assumable mortgage, but the downside is there's no process in place for most mortgage companies. There's no set pathway. So I could do an assumable mortgage with my mortgage company. It'd take 45 days. Another person could do assumable mortgage with their mortgage company. It could take 60 days. It could take 30. I mean, I've been reading stories where it's taken 6 months, 120 days, 90 days, Some people said they don't know, because they don't know the process. And that does not mean that you're going to be qualified. And if you're not qualified, then you have to figure out another route. The other part is assumable mortgage really only work for a person who has a nice chunk of cash. Because in this case that we're talking about, if the seller owes $300,000 and they're selling it for $500,000, you have to have $200,000 available to put down to make it whole. So you're bringing $200,000 to closing. Who does this work for? Someone who has recently sold their house or have a big chunk of cash. Maybe they inherited it and they can put down $200,000 or pay $200,000 in order for you to take over that property. Your credit still has to be good. Your debt to income ratio still has to be good. And with those servicers, they're not like typical mortgage companies. They're going to be a little bit more conservative on what they take in. They don't have to accept the assumable mortgage, whether it's FHA, VA, or USDA, because they're assumable. They don't have to approve you. So there's there's upsides to a 3% mortgage rate that everyone's talking about. However, once you start digging into the weeds and trying to figure out if this is a viable solution, it's going to take a lot more time than most people expect. If you come across a listing that you're interested in and you say, hey, I would like to assume this mortgage, the first question I would ask the listing agent is, have you reached out to your seller's mortgage company to see how long this process is? Because if you can reach out and make that simple phone call in the beginning and figure out how long the process is, that could alleviate some pain along the way. If we know it's going to be 90 days, then everyone has an expectation of, hey, it's going to take 90 days for us to get an answer on whether you qualify or can assume this loan. You also want to find out, okay, when does the 90 days start? Does the 90 days start once I've submitted everything, all the information of the packet? Is it 90 days? Is it going to be reviewed? Is it going to take 30 days to be reviewed? They give me an answer and then I come up with the rest of the information. Like, what's the process? Before you jump in and say, hey, let's get this 3% interest rate and go through it, you might want to see if any legwork was done up front by the listing agent or even the seller, just to see if it's even assumable. I've even seen some people try to do an in-house, like a family assumable mortgage. And if you're doing that and you're going to try to let someone assume your mortgage, or you're doing it for sale by owner, you want to reach out to the servicer and get those questions answered as well. Because in those transactions, you have two people who do not do real estate on an everyday basis trying to navigate through a non-traditional type of deal, right? So you want to make sure you have everything lined up so that it's not as cumbersome or a tedious process, more tedious process to an already tedious process. If you have found this video helpful, hit the like button. If you are new to the channel, do me a huge favor and subscribe. If you have any questions pertaining to assumable mortgages that I have not answered, you can drop it in the comments and I will do my best to answer it. I'm Kevin Jefferson, the People's Lender. Thank you and have a great day.